You could retire with $2 million and still hand the IRS a check for nothing. Not because you did something wrong, because you pulled money out of the wrong account, in the wrong order, in the wrong year. And almost nobody tells you this before it's too late to fix it. Here's the thing that should scare you a little. A finance influencer with over 1 million followers just posted a video claiming a retired couple can pull $130,000 a year forever and pay zero federal tax on it. It went viral. People are planning their entire retirement around it right now, and financial advisors are quietly losing their minds. Because the math only works if you ignore Social Security, ignore your pension, ignore your required withdrawals, and ignore about 6 other things real retirees actually have. He's not lying exactly. He's leaving out the part that matters. So let's do this the right way. Stick with me, because by the end, you'll know exactly how much of your own money you can pull out completely tax-free. And the one ordering mistake that quietly costs retirees thousands every single year. Start with the real rule, the one buried in the tax code that actually works. It's called the 0% capital gains bracket. For 2026, if you're single and your taxable income stays under $49,450, your long-term investment gains get taxed at exactly zero. Married and filing jointly, that number jumps to $98,900. Not a deduction, not a delay, zero permanently on every dollar that fits inside that window. Now here's what that influencer skipped, and it's the whole game. Taxable income isn't just your gains, it's everything. Social Security, once enough of it becomes taxable. Pension checks, required withdrawals from a traditional 401k once you hit your 70s. Interest from a savings account. All of that stacks on top of your gains, and it eats the 0% space before you ever get to touch it. A retiree with $3 million and 6 figures of unavoidable income from those sources has almost none of that zero bracket left. That's not a technicality. That's the difference between a real strategy and a viral lie. So who does this actually work for? Someone in a genuinely low income year? A recent retiree who hasn't started Social Security yet? Someone between jobs? A couple living mostly off savings before the required withdrawals kick in? If that's you, or it will be you for even 1 or 2 years, this is real money sitting on the table. Picture someone who retires at 62 but doesn't plan to start Social Security until 70. For those 8 years, their taxable income can be almost nothing but investment gains. That's not a rare edge case, that's a normal boring retirement timeline, and it means an 8-year window where the 0% bracket isn't a loophole. It's just sitting there, unused, most years, because nobody told them to look for it. Here's how you actually use it. You sell an investment you've held over a year, one that's gone up in value. If the gain lands inside your 0% space, you owe nothing on it, federally. Then, and this is the part almost nobody knows, you can buy the exact same investment right back, the very next day. That resets your cost basis higher, locks in the gain, tax-free, forever. It's called tax gain harvesting, and unlike the wash sale rule for losses, there's no waiting period for gains, none. You can do this every single year you qualify. Here's what that looks like in practice. Say you bought shares years ago for $20,000, and today they're worth $45,000. That's a $25,000 gain sitting there, unrealized. If you're inside your 0% window this year, you sell the whole position, realize the $25,000 gain, pay nothing on it federally, and immediately buy the same shares back at $45,000. You still own the exact same investment, but your cost basis just jumped from $20,000 to $45,000. Next time you sell, you're only taxed on gains above that new, higher number. You didn't change your portfolio, you just permanently erased $25,000 of future tax liability for free. But here's the mistake that's actually costing people money right now. And it has nothing to do with the zero brackets directly. It's the order you pull money from your accounts. Most retirees default to whatever's easiest: Social Security first, then the 401k, then savings, whatever feels natural. That default order is often the single most expensive decision of their retirement, and they never find out because nobody sends a bill that says this cost you $11,000 this year. It just quietly happens. Here's why order matters so much. Every dollar you pull from a traditional 401k or IRA counts as ordinary income. It's taxed first, and it can push your Social Security from partially taxable to almost entirely taxable, and it can shove your investment gains straight out of that 0% window and into the 15% bracket. Pull from a taxable brokerage account instead, using stock you've already paid for, and only the gain portion is taxed, sometimes at zero. Same total dollars spent, wildly different tax bill, just from changing what you touch first. Let's make this concrete. Picture a retired couple with $2 million split across a 401k, a Roth, and a regular brokerage account. If they draw mostly from the 401k first, they can trigger tens of thousands in extra tax over a decade, because every withdrawal is fully taxable and it keeps crowding out their zero bracket. Draw first from the brokerage using shares with a high cost basis and lean on that 0% window for gains and the math flips. Same net income to live on. A dramatically smaller bill to the government. Run it with real numbers for 1 year. Pull $40,000 from a 401k, and the entire $40,000 is ordinary taxable income, stacking on top of everything else, potentially pushing part of it into the 15 or even 22% bracket. Pull that same $40,000 from a brokerage account where you'd only gain $10,000 of it, and just that $10,000 gain is what gets taxed, often at 0% if you're inside the threshold. Same $40,000 in your pocket. One version can owe several $1,000s in tax. The other can owe nothing. The account you have doesn't decide your tax rate. The order you touch them in does. There's a piece of friction here I have to be straight with you about, because this channel doesn't sell fairy tales. Realizing a gain, even at zero federal tax, raises your income for other purposes. It can shrink an Affordable Care Act subsidy. Here's a real number to anchor that. Cross certain income thresholds and your Medicare Part B premium can jump by hundreds of dollars a month 2 years later, because IRMAA looks back at your tax return from 2 years prior. A big harvesting year today can quietly raise your healthcare costs in the future. None of this means don't do it. It means spread large gains across multiple years instead of harvesting everything at once. And check your ACA and Medicare numbers before you decide how much to realize in any single year. And states don't all play along. California taxes capital gains as regular income, no zero bracket at all. You check your full picture before you pull the trigger, not after. And here's why almost nobody does this, even though it costs them nothing to try. Most financial advice online is written for people still working, still earning a paycheck, still in a high bracket. The 0% window mostly opens during the specific temporary years around retirement, before Social Security starts, and before required withdrawals begin. It's a narrow door. Miss those years without realizing it, and the door closes, and nobody ever tells you it was even there. So here's the actual playbook, the version that survives. Contact with the real tax code. Know your two thresholds for this year: 49,450 single, 98,900 married. Add your standard deduction on top of that, because it's taxed before the bracket even starts, giving you extra room. Before you touch a 401k or start Social Security, look at whether you're sitting in a low income year, because that's your one shot at this. If you are, harvest gains up to the edge of that zero bracket, not a dollar over, and consider rebuying immediately to reset your basis for next time. And get your withdrawal order right before your first retirement paycheck, not 5 years in when the pattern's already locked in and the money's already gone. Here's the takeaway that actually matters, more than any single number in this video. The tax code doesn't reward how much you have. It rewards understanding which account to touch and when. Two people with identical net worth can retire into completely different tax realities based on nothing but sequence. That influencer with 1 million followers isn't wrong that the 0% bracket is real. He's wrong that it's simple. It's not simple. It's precise. And precise is exactly what saves you thousands instead of costing you thousands. Two things to actually remember when this video ends. Check whether you're in a low income window before you touch a single account. And when you do withdraw, the brokerage account almost always comes with a smaller tax bill than the 401k, dollar for dollar. This is education, not personalized financial or tax advice. And every number here can shift with your state, your other income, and future law changes. So run your specific situation, pause the professional before you act on it. But now you know the question to actually ask them. If this saved you from making the same mistake that influencer is about to cause 1 million people, subscribe. Because on this channel we break down exactly how the tax code actually works, one real number at a time. I'll see you in the next one.